The U.S. Consumer Inflation Report for July was a prime focus recently, but it came in a little cooler than expected. Our chief equity strategist and economist, John Blank, is here now to weigh in on that. John, the CPI rate eased a bit in July from June. Do you see that as inflation abating?
Yes, I do, Terry. I want to throw out some numbers for you. Obviously, the year-on-year effect is now at 8.5% before seasonal adjustments, going back 8.5%. But if you look at adjusted changes from the preceding month, I'll just throw them out there. I pulled it up. January 2022 for all items, 0.6, February 0.8, March 1.2, April 0.3, May 1.0, June 1.3, and yes, July 0.0. So everybody was kind of getting down on President Biden about not saying there was 0% inflation, but what he was referencing is the month-on-month change in July was 0.0. And so having thrown out the prior 6 months of data, that was not a decline, but it was at least no longer a rise.
Right, but if you break that data down to goods versus services, what does the picture look like?
Well, that gets to different questions. Services less energy services is at a 5.5% year-on-year rate. So that is a little concerning. All items less food and energy is 5.9. But I think services less energy services, which we don't often talk about, Terry, is kind of an interesting number to keep in mind, 5.5%. That is much less than 8.5%. And that's kind of that's the translation we need to worry about from the Fed. The Fed cares about that number. And frankly, 5.5% is way higher than 2%, which is what their statutory, mandate is. So they're way over that. But if you think about how high real interest rates, like thinking about the Federal Reserve rate that they're putting out there, 2.5% versus the 5.5%, it's still very negative. There's still a very negative, very accommodated real rate because inflation is 5.5% in this context.
Now, does this data remain the primary driver to Fed rate hikes here going forward?
Absolutely, yes, Terry. This is the only driver now because the other statutory driver, which is the unemployment rate, is 3.5%, which is frictional.
All right, and what about the central bank activity globally?
Well, we're talking here on Tuesday, the August the 23rd. On Friday, Powell will be in Jackson Hole, and he will discuss the global economy with his counterparts. If you're going to travel to Japan or Europe, particularly euro is below parity with the dollar now, you're going to get a great deal. I would definitely recommend people look into Europe for travel. And that's really interesting right now. There's a lot of weak economies out there outside the United States.
While real GDP also decreased a bit in the second quarter of 2022, it seems as though our economy is still on kind of a narrow path. But you say in a recent commentary that path leads to a soft landing. So what would indicate that?
Well, Terry, we've got, for example, I've had the employment situation for July, we added 528,000 jobs. And in June, we added 398,000 jobs. In May, we added 386,000 jobs. So the basic point is not only are we not a soft landing, we're in a hot economy right now. And that when you leave a hot economy, your first place is not a tanking economy, but a softer economy. And that's basically the point.
So the U.S. economy has or has not actively cooled down?
It hasn't cooled down much, really. I mean, there's elements that have cooled down. The housing market's cooled down. The gas prices have cooled down. That is reflected in that July 0.0% monthly change. But that's not much. It's not cooling. It's not getting hotter, basically.
So do you expect this scenario to continue going forward, or have we plateaued here for a time?
Well, that's the big question the market's wrestling with, Terry. Have we plateaued or are we going down? And that is something we'll let the data talk to.
Okay. Earlier, you mentioned the Jackson Hole Symposium later this week. And as we talk here on August the 23rd, when you look forward to that, how important is that meeting going to be to you in light of the stronger dollar?
It's going to mean nothing, Terry. That's just going to be chatting amongst very high level, and we're going to learn nothing from them.
That being the case, let's take a look at a few strong buy stocks that you're looking at that include HSBC, BP, and Coca-Cola FEMSA.
Yeah, let's talk HSBC. This is Hong Kong Shanghai Banking Corporation. Zach's number one ranked stock with a B for value. You can get into this stock for $32 a share now. That's a pretty good price, and the PEG ratio is 0.46. The forward PE is 9. Good time to look into HSBC. BP, also number one ranked stock. I have a little trouble with this one just because I think the oil prices are going down, not up. But so I would probably stay away from it. But it is number one ranked stock with an A for value and A for growth. And Coca-Cola FEMSA, this is another big international stock. This is the Coke brands out there, and this is the one through Mexico City and the metropolitan area around there, as well as Buenos Aires. So here you've got a stock, again, B for growth, number one rank. You kind of have to like a stock like this in this environment.
Our chief equity strategist and economist, John Blank, with another look at the economic picture. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.